Hey everybody, Preston Bryn here with our weekly roundup from the Trader User Group. This is for the trading week ending July 15, 2016. What an interesting several weeks we've had, at least certainly post-Brexit vote. Um, it's just we've seemed to have interesting things pop up every week, but nothing has really been able to stop the bull market that we've been under post-Brexit vote. I mean, it's like a bull in a china shop. Um, and even despite this unbelievably horrific attack in Nice, and then right at market close, a quick downdraft in the market because of a potential coup or a coup attempt in Turkey, which seemed to have failed. The market seemed to be just moving along very strongly. The Dow is, 5 for 5 for the week, up a little over 2%. The S&P and NASDAQ are a little bit over 1.5%. And the Russell small cap is up about 2.4%. So we've had a balance of about 8 to 9% since the post-Brexit vote. And I think that caught a lot of people by surprise. It's probably one of the most hated bull markets I've been involved with, which to some contrarian perspective could probably drive it up a little bit higher. But it really, it's amazing. Now we have the FOMC meeting the end of this month. The market is not really forecasting right now that there's going to be a probability of a rate hike this year. It's down in the 20% area. But keep in mind that this Fed membership team here, they've been known to turn on a dime very quickly. They frustrated a lot of traders. But they've got a meeting on the 26th and 27th of this month. So, you could expect anything out of them. And if we continue to get solid economic data, then perhaps the market, the 30-day Fed fund futures will price in a higher likelihood, although well under 50% of a rate hike. Most market makers or analysts don't believe we'll see a rate hike until 2017 at the earliest. But, these Feds have been known to surprise everybody, so we've got to be very careful there. In the short term, I think some people have seen or feel that the bull market is starting to run out of juice after this, as I said, this 8% bounce off the Brexit lows. But I think there is a little bit of over exuberance here. If you look at some of the leaders in the market, they're not the type of leaders that I would like to see. I mean, some of the hottest sectors are things like telecom or utilities. Utilities is up over 20%, and telecom, they're up over 22%, and yet the financials, they were just a little while ago in the red. Now we've got some financial earnings coming out. We had JP Morgan, Wells Fargo, and we had BlackRock, and then next week we got a couple of others coming out. Kind of a mixed bag, but this earnings season is still not shaping up to be very good. Valuations are rising. Typically, if we're seeing rising valuations, PE ratios accompanied by rising profits, that'd be one thing. But we're not seeing that. In fact, Q2 earnings here are projected to come in about 5% decline, and that would be 5 straight quarters in a row that we've got a decline in earnings. And the S&P right now is already trading about 18.5 or so. And, we get a lot of, where there's a record buyback of shares. Companies are, buying back their float, so they're taking shares off the market. So that's one way to financially engineer earnings per share. But, that just can't keep going on here. So it is going to be very interesting to see how everything shakes out here and how the markets move. What I've got on the screen here is the S&P 500 E-mini futures. And as you can see, I've got a lot of lines on this screen, but let me see if I can't decipher some of this for you. You can see the Brexit vote right there, and then we came a hard down. We did not make our 2016 lows. That was made back in February the 11th right there, and then we had just a beautiful signal, and I just had all our members jumping long back at that point in time. In fact, we over allocated into the energy markets because I was telling our members in Q3 and Q4 of last year, we had a cyclical change in the energy markets where we were looking for a bullish bounce, and then of course that was aided by the seasonality aspect of oil and gas, just how they tend to be seasonally. And then of course we got a signal here, and I just said things are lining up, so let's take the trade. And we stayed in it for a while. It was a nice run for a lot of folks. And then you can see here the former all-time highs that we spent over 350, almost 400 days trying to take out, and then we finally took it out this past week. You can see we took it out with abandon here, 2134 in the S&P 500 futures. And then we ran up and we made new all-time highs here on 2168. So we're right at that point right there. So where do we go from here? Well, you'll see this colored bar up here, this really big colored bar. I had projected off the Brexit vote, coming back up to the 2016 open price right there, which is 2037.75. I had projected we would probably see our Elliott Wave 5 pattern start to run into difficulty, but that was the projection that I had put out there. So we've been, holding our teeth, or gritting our teeth here a little bit, but I expected the price to move up to 2,200. So that's why we've been holding on here to the upside, but I don't like doing it. But doesn't really matter. Logic does not play into these markets. You got to go where the price action wants to go. And I'm sure some of you have already heard this term before, but it's floating around in the financial press and everywhere else. But the word TINA, which basically means there is no alternative. Meaning you've got, and I've been talking about this now for over 6 months, you've got around 13 trillion in minus interest rates in treasury notes, 13 trillion. And so what have you got when you've got the Bank of Japan, you've got these sovereign wealth funds, you've got a lot of Europe, and the German Bund, which is one of the premier debt instruments over in Europe, and they go negative, and then all that money is sitting there. What does it go? It comes over into our market, so it drives our bond rates. It drives bonds, through the roof, and then it drives our interest rates down even lower. Okay, so we've had this huge run up in bonds. And this is one of those instances where we're seeing a huge run up in bonds and we're seeing a huge run up in equities at the same time, which is an unusual correlation. But again, it's because of this guy right here. There is no alternative. So money is coming in offshore into our bond market and into our equity market. But in our equities, as I said at the opening, things like XLU is leading the way, which is a utility sector, or staples sector, or telecoms. These things are just driving in search of yield. Now this too shall end. And when we start to see some more clarity across Europe, and perhaps over in Japan, you'll see some of this money reverse course and come back out, and then you will see bonds flip over and roll down, and you'll see interest rates come back up. Now, we've had a little bit of a downward move in bonds over the past couple of days and an upward move in interest rates, but in the scheme of things, not very much. But that signal will come, and we're going to want to jump on it. So this is where we're sitting right here. Now, if we look at this, if I take it out for a weekly chart, this is how, if you look here, how I see the area right here on my E-signal chart. Now, I could do this with a combination of Gann and Fibonacci, but it's quite frankly easier to just do it with a one click by clicking on something that it calls the mob, and it will project it up here. But I essentially can get the same data by doing a fib extension off the prior pivot highs and the lows, as well as doing a Gann extension. And by the way, Fibonacci also has time extensions too, but this has essentially been very accurate, and it was projecting right around the 2200 level by the first week in August. Now, sometimes we hit it sooner, sometimes we hit it later, sometimes we don't even hit it. It's not telling you this is what's going to happen. It just gives you the higher probability of what you can expect. It gives you a little bit of an edge. So we saw this off the Brexit vote right there, and it was sitting on this thing here. In fact, this was back all the way back. This is a weekly chart. Back in February, we had this projection up in this area here, which is amazing because at that time, it was just like, there's no way we can get up to 2200, because if you guys remember, around the February 11th time, we were down around the 1800 level. And at that point in time, from 1800 up to 2200, That's 400 points. But that's what the chart was calling for. And you know, you take it a day at a time, obviously. But, you know, with each new day bar that came through and printed, we were, you know, continuing to improve our odds on this is where we want to go. So this is where it looks like we're heading right now. Now, if we come into the 2-hour chart, a lot of you know I like to pair a 2-hour chart with a daily chart. You can see here in this 2-hour chart, we also had this little bit of a divergence here. And I like these kind of patterns where you get, you know, these a little bit of a cleaner divergence here. So it's pointing down, and we got a signal right here on a 2-hour chart. Say, okay, the price is going to weaken up a little bit, so you can come in here and, you know, sell SPX calls, do a bear call spread, or your shorter call and your longer call, something like this, you know, with SPX. Or you can do it in the E-minis, or you can do it in the spiders. Doesn't really matter what, right? But we got that little bit of weakness, and then boom, we're sitting here right now. Here is our former all-time highs in the E-mini S&P 500, 2134. We closed the day at 2146. We're well off our opening price for the year, but this line right here, the 2134, it's taken us almost a year and a half or so to take that number out. So this area here is going to act like a magnet. You know, we had a break here, but it's going to act like a magnet to come back down and do another retest. At that second retest, should it occur, let's watch it very closely, because if it bounces and starts moving up, you're going to see more longs coming in on that bounce back up again. If it tests this line and then comes back down in this area here, then we're just going to muddle along again until the markets get a little bit more clarity on the earnings, as we're, you know, just now kicking off Q2 earnings. So this is a little bit about how this chart looks on the S&P 500. Now, if we look at the Russell, the small cap, you can see here in the small cap, we made new 2016 highs here. Let's take it out to the daily chart. You can see the open price. We're well up here. Again, another 3-4-5 pattern. And for Elliott wave theorists out there, a 5-leg. Generally, after a 5-leg, you have an ABC pattern, which shows you some chop before the markets, you know, decide, you know, what do I want to do again, right? So that's a typical pattern after a 5-leg pattern. And this is a primary wave structure, 3-4-5, like that. So we don't have what I would see would be any bearish divergence. Should we get a pullback, that would tell me that the pullback will be a very short drop before we get another pop again, possibly running at the 2016 highs for the Russell. I'd like to see more participation in the Russell. That would be a good thing. If we look at the NASDAQ has been hurting, and if you look at NASDAQ, you'll see the 2016 open price in blue. You'll see the 2016 high price in red. They're almost right together because it happened almost on the same day, and then we closed right here. So the NASDAQ 100 futures is the only one that we're in the red on. Now we've got Facebook, Amazon, Google, some other big flyers in the larger tech space that are going to be doing earnings. And if these pop, this thing is going to come back up here. And my target for the NASDAQ 100 futures is right around 46.60, somewhere in that area there. So that suggests that any move down like this is going to be met back up again. So all of my charts indicate we still have some more upward action to go in the major indexes. Now, another thing that I'm watching here is the Dow Jones. Well, let me get it back up. Let's get this thing up. The Dow Jones Transports, IYT, the ETF. You can see here that we're not at the 2016 high. So we made a new high in the Dow. And if we make a new high in the transports, that's a good, very bullish, longer term signal. We made a 2016 high back in April of this year. So if we can take this out, that is a very strong signal, guys. We've had these huge bounces here. Now, a lot of this movement, please understand, a lot of this movement is there's no other alternatives. It's in search of yield. So you've got a lot of money coming to the equity markets, much like you dig a hole in the ground or a trench and you force water from the lake into your field to put water into your crops. Well, this is the same thing. Central banks from Japan to China to all across Europe, Great Britain, have really committed to just very loose monetary policy. A lot of stimulus. The U.S. markets, well, the Feds here are the only ones sitting on the sidelines, but uh, that in and of itself is a loose policy because they had already said there would be 4 rate hikes this year, and they backed off of that completely. And the markets now are forecasting probably about a 20% chance of a rate hike in Q4. So we've got to watch this very closely here. Watch the transports. But if we get a move up here, this is going to continue to move up. Markets can go a lot longer, further, and faster than you think. Also on Friday, we had the, let me find it here. Where is it? The VIX. We had the VIX close over the last couple of days. We made new 2016 lows in the VIX. If I just kind of move these up a little bit, you can see here. 2014, or I'm sorry, 1214 in the VIX right here. So for those of you that are credit spread traders out there, you can see here that I've got the VIX color-coded in various zones. And these zones dictate for us, at least for our members, and what I suggest, a percent of capital allocation into credit spreads versus debit spreads. And if you're a big credit spread player like you do income, whether it's iron condors using SPX or some other instrument, generally when we've got volatility in this green zone, you do not want to be a seller of premium because the odds favor it popping back up again. But we're now, the VIX closed Friday at 1267. That is a very, that's as low as we've seen almost this whole year. But we did make the low for the VIX for 2016 just a few days ago this week. So we got to watch this very carefully, guys, because generally when it gets down into the green area here, we're subject to impulse moves to the upside and volatility, which would be drops to the downside. Bond market, we've been following that. You can see here the bond market is just on a tear. We blew right through my resistance zone up here at 170. We actually hit up to 177. A lot of this, guys, it's going to come back down again because a lot of this is money pouring into our country from, as I said, Japan and primarily Europe, because our yields are so much better, and Great Britain for that matter. But we're having this impulse move back down. I don't think it's going to go much further down until we get some more clarity on U.S. earnings, but this has the propensity to go much lower, which would drive interest rates higher. Now, we've been playing this in TBT. You can see in the scheme of things, TBT has barely moved. Just going back to January of this year, TBT was at 44. It's at 31 right now. Okay, so it's coming off the bottom. But we don't have a longer term signal yet for this one. But I think we're going to get one shortly if the markets start to continue their trek higher. If we look at the 30-year interest rate, you can see here again, we're coming off the bottom. We're hitting a major support zone here, as you can see. If I take it out to a weekly chart so that you can see the bottoming pattern. We came in and we hit it almost timed perfectly. Remember, these bars are projected for time extension right here, which would put us from early summer of last year to summer of this year, when we could expect this. And then sure enough, we got it right here in the beginning of July. So from 2015 of last year all the way through, but this was the range, and then we just moved up and now we're sitting back down in this area here. So I don't think we're going to go much lower. I think the longer term is either going to be choppy to up like this. So playing interest rates up, but they're not going to rise as fast as you think, at least for the next 12 months. But then we're going to have a period of time when interest rates are really going to fly, and you're going to want to be long rates or you're going to want to be short bonds, one or the other. The other one that we looked at that we played was the British pound. You can see the British pound with that huge drop off on the Brexit vote. We were selling the hell out of the pound 1 o'clock in the morning after the vote. We were watching the polling results. I had our members in our chat room, and we were trading the pound to the downside. You can see the 2016 high price and the 2016 low price for the pound. Now, we've had this big move down right here. There's just a ton of shorts in this thing, so it's kind of short heavy, and any movement up like this is probably going to be met by more further selling, but there'll be fast moves up because there's a lot of shorts. There'll be a lot of buy stops triggered. I think the upside in this thing at the best case is probably around 139. I don't even know if we're going to get back up there. Mark Carney last week did not raise the rates, so it tended to put a little bit of bullishness into the pound, but I think it's going to roll back over again, and we're going to come down and test these lows because he's talking already about doing more stimulus, so that'll weaken the pound. And of course, with the Japanese yen, and let's just take it out to a daily chart here so you can see. I was telling our members this would be a good place up in this area here to be selling. Bear call spreads above the yen. And sure enough, we're coming down, and we're sitting here right now on this 50 EMA. So Shinzo Abe is, he's been given a third. He's been, he succeeded in the vote, so he's going to come back out again and just really pepper it with probably more stimulus. So I think the yen is selling off in anticipation of that. So, and then if we look at gold, gold is down just a little bit. It was up a little bit on Friday. But again, we hit my target in gold, which was 1370, hit it very nicely. No bearish divergence near term, so I think gold is going to pull back a little bit and is going to start another run again. And we've also been trading long silver. I've been in silver for a couple of years now. We blew right through my target. It overextended, went all the way up here. We're having a little bit of a pullback. This will act as a support point around the 1915 area for silver futures. No bearish divergences in this at all. You can see the 2016 open price way down here, this blue line, and that red line is the 2016 low price. So we're well off. I mean, we're flying in 2016 for silver. It's a little bit more strong than gold. If we look at oil very quickly, the key with oil is going to be the 200 EMA right here. That's going to be this line right here. We've been holding it over a week now. I think oil is going to break. I think it's going to break it to the downside. We're going to come down and test this natural price level right here around 41, roughly. 41.90, I think is what it says. And we're going to probably come down to the low 40s here. And then we may go a little bit lower. But you can see if I were to just draw this like this, that's kind of where we've been heading since we hit the 2016 high. I was calling this year for oil to not go higher than 55 and not go lower than, let's say, 40. I may revise 40 down a little bit, but it's a wide range, but it still allows you to sell calls above and puts below if you're doing short strangles in the futures market, or if you want to trade USO because you can't get into options on the futures if you're in a 401k or an IRA, or they won't let you do it. Then bear put spreads, in the money bear put spreads up above the price makes sense to me using USO. And then finally with agriculture, we've had 5 hits in a row with soybeans. Just to show you guys, if you look at wheat, we're near the lows in wheat, right? Here's the low price for wheat, opening price, high price for wheat. You can see we're near the low for wheat. We look at corn, it's going to be the same thing. We're near the low for corn right here. Here is the high price, low price, the opening price. The opening price and the low price are very close together. So corn spent most of the year outside of this run up in middle of summer, early summer, just selling off dramatically. But look at soybeans. Soybeans is just the opposite. We're coming off the highs. We're well above the opening price and the low price. Here's soybeans up here. So when soybeans was at 2016 highs and wheat and corn were near 2016 lows, I had recommended a pair trade where you sell soybeans and buy corn or wheat. It turned out to be a really nice trade. I personally didn't take it, but it was a trade that was, to me, it made a lot of sense, right? So this is kind of where we're sitting right now, folks. The markets, if I go back into the E-mini S&P 500 futures, let's put it on a 5-minute chart. You will see the last few minutes of the session right here as we closed out Friday. The market sold off a little bit right in that area there, and then the coup, it had already started here, so people already got wind of it here, but then it hit the official news wires around 4:35 p.m. and then the market immediately sold off and did one of these things like this. Now, they've solved that issue. Turkey's back in charge, but it's created a lot of issues. So we got the E-minis moved down and it closed down 11:25 for the day. We were up here around 21:52, and then it proceeded to sell off all the way down to almost 21.42, and then it gained back up about 4 points before close for the weekend. So we had that nice little drop for the coup attempt in Turkey. So it's going to be real interesting to see how this thing picks itself back up. If the fear is gone and then it starts working its way higher, or it just head fakes and we call back over again. All right, everybody, for our members, I will see you Sunday night on our weekly Market Watch. If you're not a member, I highly encourage you to come in and check us out. You've been probably watching my weekly updates. You know that we're tracking the markets pretty good. The calls that we've been saying here, it gives you a little bit of an edge, which is what we like to see in the market. All right, everybody, have a great weekend, and I will see our members tomorrow night just to kind of check out the earnings coming up for the week and where we want to be and what we can possibly expect. Have a good one, everybody. Ciao.